and strictly commercial. And we're going to be closing this 250 unit with us as well as our passive investors. So we're going to get right into it. All right, first off, there is a disclaimer. This isn't the offering. This is not the offering memorandum. You'll get that in the PPM. So this is not a solicitation, but the solicitation will come later. Also, everything that we learned in here is information that we actually got from the sellers. So some of the information we are going off of our contractors or our sellers. So that is just to let you know.
Okay.
All right, so it is a $11 million property. It's 250 units. We're bringing in $6.2 million in equity. There's a minimum investment of $75,000. Of course, you can go up to a little over $700,000, but at least $75K. The hold period is going to be 5 years, and that's how long the loan period is as well. So the investors, the passive investors, will own 80% of this deal. And us as the sponsors, my team, we are going to own 20% of the deal. And you're asking, is there a preferred return? So the answer is yes, there absolutely is a preferred return. We want to make sure that you get paid. And that is going to start by having cash distributions in the very first quarter. So to be paid quarterly and a 7% annualized return coming out to the passive investors. And if you're wondering how much you're going to make over the lifespan of this 5 years, is about 95%. After you get your money back, there'll be another 95% in earnings. And so that is the projection. And so if you annualize that, divide that 95% by the 5 years, it's a little over 19% annualized. Your IRR, your time value of money, will feel like 15.8, almost 16%, which is very good. All right, next slide, please. So here's a few questions that you and other passive investors that we have had have wondered. They're wondering, are there any fees? Are the sponsors charging any fees to operate this deal? And yes, they are the typical fees. So there is an acquisition fee, typical size. There's an asset management fee, which is going to benefit you. You're happy to know that we will be having an asset management fee, because that shows that we are going to get paid to manage this deal, because the first 2 years are going to be slim for us, and you want to make sure that your operators are making a little bit of money. They have incentive to continue to operate this deal. The next question that you're probably going to be asking is how the sponsors' interests are aligned. I understand that you're taking the fees. I wonder how your interests are aligned with mine. I'm the passive investor, and I'm very curious what's going on. Well, there's two ways that we make sure that our interests are aligned with yours. And the first way that we want to make sure that our interests are aligned with yours is that we're, of course, as we mentioned before, we have a preferred return. And so you get paid that 7% before we start splitting the 80-20. So you get the 7% first as a preferred return. And the other way that we are in aligning ourselves with you is that I, Adam Adams, am personally putting my own capital into the deal. In fact, I already have my own capital in the deal right now as it stands. And my money is on the line. And not only that, but once I get the acquisition and we're closed, I'll have my own cash. Not only that, but Blue Spruce will have its own cash. And many of the sponsors, they don't have the capital put in there, but they're telling me, I wish I could, because this is one of the best deals that I've seen. So how are the interests aligned? Number one, we are doing a preferred return, so you get paid before we start splitting. And the second one is that I've got my own money in there. Blue Spruce has their own money. Other sponsors are likely to be having their own money. So we're passively invested right next to you. The next one is wondering about the sponsor's track record. And so I'm going to turn it over to DJ right now.
Hello, everyone. I'm happy to talk about the sponsors. We have an outstanding team that we put together on this. Some of them are on the call, some of them are not, just because of logistics, but I will run through all of these folks. So Garrett Lynch is the one who brought us this deal. Garrett is a superstar. He built up a portfolio of 3,000 multifamily units over 5 years, including 800 in Oklahoma City. And he unwound that a couple of years ago, and he started back up. And so we're happy to have Garrett on board with this, someone who's incredibly experienced at this. Gail also owns several hundred units, has been investing for about 13 years. And she is working with us on raising capital and also asset management things. I am up here in the upper right. I am also the asset manager on this deal. My background is tech startups and also real estate for the last few years. I've done just about everything you can imagine, from sales to marketing to raising money to selling a company. So to me, asset management is right in my wheelhouse. Corey is our local partner in Oklahoma City. Corey is one of the biggest wholesalers in the area. He does well over 100 transactions a year. He's done over 1,000 transactions in his career, and he's done lots of other entrepreneurial ventures. And he knows the Oklahoma City market like the back of his hand. He grew up in Oklahoma. He's lived in Oklahoma City for the last 20 plus years, really understands the market. And so we're really, really grateful to have Corey on board with us, because he can tell us right away, is this a good deal or not? Is this a good market or not? Is this a good property or not? And he's right there within a 10-minute drive. Rich is also on the call. Rich is a construction advisor. Now, Rich runs a company called Gage Multifamily. Gage Multifamily is a construction company. So they do exclusively rehab of multifamily properties. He's done well over 1,000 units of rehab. And we brought him on because, as we'll get into a little bit later on, there's quite a bit of construction work that's going to be done on this property. And what Rich is going to do is he's going to advise us. So he's not the general contractor. He's going to help us pick the general contractor and hold the general contractor accountable. And we really like that. It's the best of both worlds. You got someone who's super experienced, but there's no conflict of interest where he's going to be trying to bill us extra for his services. He's purely an advisory role and make sure that our contractor does a good job. And of course, the incomparable Adam Adams, many of you already know. He's been doing real estate for how long, Adam?
14 years on my own.
14 years. I've known Adam for the last 3 years. We partnered up about 2.5 years ago to do multifamily, and it's been a lot of fun. Now, this is the sponsor team, but I also want to talk a little bit about the property management company. We spent a lot of time looking at property management companies, and we ultimately selected Trinity, and the numbers here speak for themselves. They're managing over 23,000 units in 15 states, 3,000 units just in Oklahoma City alone, including a 150-unit complex that's almost right across the street from this asset we're going to be showing you tonight. So they know this market very well. They're very experienced, and their specialty is turnaround situations, taking a property that's suboptimal, coming in, placing in better management, doing some rehab if necessary, and getting it up to 90+% occupancy. Let's talk a little bit about Oklahoma City. Adam, why don't you, actually, no, I'll take this one. So I'm not going to sit here and read through every bullet point. That's really boring. You can read through these, and these are also in the deal packet as well. But we really like Oklahoma City for a few different reasons. So one is, I call it the Goldilocks market. It's not too hot. It's not too cold. It's just right. It's been very steady growth for the last 30 years. And I'm not kidding. Steady growth for 30 years. And in the last 10 years, it's accelerated to about between 1.5% and 2% a year. The job growth is consistent with that, often over 2% growth. And the projections are that's just going to keep happening. It's just a very steady state market that grows pretty much like clockwork. But the other thing we like about it is the city has invested a lot of money in making it a desirable and attractive place, both for the residents and for businesses. So the MAPS program that's mentioned in that last bullet point is a series of initiatives they've done starting about 20 years ago. And each time it's gotten bigger and bigger. So the first one was about a $200 million investment. The next one was on the order of $500 million. They just completed the third one, $700+ million, and the next one's going to be close to $1 billion. And those are basically 4-year plans where they invest in the city's infrastructure. They do things like redevelop the downtown, do things to attract teams like the Oklahoma City Thunder to come play basketball there. Just really improve the quality of life. And as we'll show you in a little bit, that's very obvious. And in particular, the neighborhood that we're going to be showing you, there's been a lot of just very obvious development there. Now, a lot of people, when they hear about Oklahoma City, the first question they have is, isn't that an oil and gas place? Is Oklahoma City really a diverse economy? And the answer is yes. So let me show you in 4 charts why this answer is yes. So don't just take my word for it. I want to show you a couple of very interesting charts that reinforce this. So number 1 is oil production. So people think oil and gas. It all just goes up and down based on oil and gas. Well, this is an interesting chart to show you. Yes, indeed, oil production in the state, this isn't Oklahoma City, this is the entire state of Oklahoma, has been growing and growing and growing. So 9 years ago, they were doing 220,000 barrels per day. Now they're up over 563. But this other chart here is the number of rigs. They are actually more productive. So they have fewer rigs producing more oil. Now, what does that mean? Well, that means that oil and gas jobs are actually kind of flat. It's not really a huge sector like you might think in the economy. And again, this is for Oklahoma statewide, not just Oklahoma City. So there's actually fewer oil and gas jobs now than there were in 2014. That's partly because, in fact, largely because they're just more efficient. So they're able to pump more oil with fewer employees, fewer rigs, and that means more money. That's more profits that flow into the economy. And what happens when those profits flow into the economy? Well, other sectors pick up the slack. And so I'm going to show you this chart and another one. This is the education and health employment. This is just in Oklahoma City. So those last 2 charts were just Oklahoma. This is Oklahoma City. And you can see that education and health, these have been growing steadily for the last 7 years. I want you to take a note of this number, 97.5 thousand jobs in Oklahoma City alone in these sectors. And then another one is, whoops, I need to go forward one, is leisure. So this is things like restaurants and hospitality and all of that. Same thing, it's been growing like crazy straight through the last 7 years. And this number, this 82.5 plus the other number I mentioned earlier, that is 3.5 times more jobs than the entire state has for oil and gas. So Oklahoma City is the opposite of just an oil patch where everything is based on the price of oil. It's a very diverse economy. And I can show you here this chart of some of the major employers there. You can see the check marks here. These are the ones that are where the headquarters are there. And if you look, yes, you're going to see some energy companies here, OG Energy, Chesapeake Energy, but you also have a lot of other interesting ones, a lot of healthcare, even a little bit of, these days you're seeing more aerospace actually has been a big growth area in Oklahoma City well. So it's a very diverse economy, and that's part of why we like it. And that's part of why we want to get into it now, because we think this is a mega trend that's going to continue for the next 10 plus years. Some quick summary about the property itself. So we showed you at the beginning, it's 250 units. The address, you can Google that, 7525 Night Lake Drive. It's built in the 70s in 2 phases, 250 units, 16 buildings, good sized plot of land. I'll show you a picture of that in a minute. And we have a broad variety of units. So whether you're a single person just looking for a 1-bedroom or a family that needs a 3-bedroom, we've got you covered. Let me just show you very quick about the location. So this gives you a sense of where it's located. So downtown Oklahoma City is down over here in the lower right. This is up about 8 or 10 miles northwest. This is the growth area of Oklahoma City. So, there's northwest, northeast, south, southeast, southwest. This is where all the action is in Oklahoma City. And so that's why we're really excited to be there. Among other things, Lake Hefner is right close by. Lake Hefner is just absolutely gorgeous. And that's part of that leisure and recreation I talked about earlier. So this is an excellent location. Let me show you the property itself. And it's kind of hard to get a sense from this without a bigger map, but this street right here that I'm tracing the mouse down right now is Lyrewood Lane. That's kind of the main street that runs through this. And this is the property itself. What I really like about this property, the way it's situated, is all up and down Lyrewood. There's other multifamily properties, including this one right across the street that's also managed by Trinity, the villas. But what's neat about it is when you turn in here, the main entrance is all the way up here. And so you're basically in a cul-de-sac when you come into this property. Where these green lines are, this is all fenced in. So it's basically a gated community, and that's good for security. So you're not going to have people who are just sort of going up and down the street cruising. If you're coming here, you're going into the property, or going out of the property, or you're going to one of these single family homes. You know, this is a side street. Some other things about the area is just the nearby attractions. So Northwest Expressway, this is just a little north of the property. If you take this, this will take you all the way downtown. And there is just a ton of activity here. Gail, why don't you talk about your experience when you drove in to see the property? If you're there.
She might need help getting unmuted if you want to try one time
Right
to
now.
do it manually.
Okay, maybe we were both doing it at the same time.
Yes.
Anyway, I was just saying that I was so excited when I drove from the airport to the property because, you know, for the first time you go, you don't know. And all the way there, and especially close to the property, Starbucks, Chili's, hotels, all of the major chains, there's just so much investment in that area, so much commerce, which is great for people who live there in terms of being able to have lots of jobs around and also being able to have all of their needs fulfilled. And in addition, the schools around that area are really truly excellent. And that's another reason why this property really has a competitive edge, because if you have children, you're going to want them to go to that school. And if you, work a retail job or in a hotel or a restaurant, it's perfect for you. And, you just have access to everything. It was really, really wonderful to see that kind of investment.
Yeah, and that's the same thing I noticed. It looks all brand new. I mean, it's just a really nice area. I've been visiting Oklahoma City for 25 years because my best friend from college lives there. And let me tell you, I can totally see the difference. It's just a really desirable place to live. This Northwest Expressway all the way to downtown is just full of shopping malls and restaurants and all the things that as a resident you would want to see. Let's talk about the school district for a second. So this one is the closest one. It's an elementary school. This is within walking distance. So Putnam Green is right here. Two Lakes is just down the street. This is rated an 8 out of 10 on greatschools.org. And there's more schools in the area. This is just in the micro market right there at Putnam Green. Corey, you know the area pretty well, and you know about the schools. Can you talk about that for a sec? We can unmute.
Can you hear me okay?
Yes.
Okay, great. Yeah, this is exciting project. The schools here on this school, Great Schools org rating goes from 0 to 10, and there's several schools right around this apartment complex that are in 9 and 10s. This one here is you're shown on the screen is an 8. There are several there. Putnam City Bethany is right around there. Elementary and high schools that are very favorable, and many families want to get into those schools, so it makes it very desirable.
Cool. Thank you, Corey. So a couple other things about the property, just to give you a sense. I mentioned the different floor plans. We have 96 one-bedroom, 122 two-bedrooms, and 32 three-bedrooms. This just gives you a sense of the different types of floor plans and how they're broken out. So lots of options for the residents to choose from. And let me just show you what it looks like. A lot of people want to see pictures for good reason. So let's dive into what this property actually looks like. So this is the exterior amenities. So there's a nice little pool there, a fitness center, playground. It's got a very nice clubhouse and business center. It's a gated community, as I mentioned, and it's grill and picnic areas. Lots of things to do within the property itself. When we were walking the property as part of our due diligence, we saw lots of kids running around having fun. It's a good place to live if you have kids and you know, it has all the amenities that you would look for in your next apartment. Some of the interiors, you know, we're a little limited in the number of pictures we have here, but that's okay. I think this really communicates it. These are nice units. I mean, I walked into it. Now, some of them are not in such good shape, and we're going to talk about that in a minute in the construction plan. But these are places that I would live in. You know, you can see just by looking that, yeah, this is a quality unit. This one right here shows a rehabbed unit. It's not the best picture, but you can see we've added backsplash here. We've resurfaced the countertops. We'll talk about that more in a little bit. But they all have washer dryer hookups. They all have hardwood and vinyl floors. Closets are huge. And some of the units also have terraces. So there's a lot to like about these from a resident perspective. And so again, that's what we really liked about this property. Now, one thing I want to tell you about is a little adventure we went on. And that was in August. During the due diligence period, there was a fire at the property. That's never a good thing to hear about. So just to give you the Cliff Notes version of it, there was one of the buildings that has 8 units. 3 of the units were pretty much completely destroyed, and 5 more were made unlivable. The fire was actually caused by it was caused by someone who left a burner on. They put a pot on the stove and forgot they had it on, walked out of the house, and you know, next thing you know, there's a fire, and that's where all this damage came from. So this, of course, made us stop in our tracks and say, well, do we want to continue with this property given the fire, and you know, not knowing what the insurance was, what the insurance situation was, how that works. So we had to spend a lot of time talking with the seller, the insurance company, the lender to make sure that we understood what we were getting into. But the great news came out of that. So one is insurance is rebuilding all of these. So that's 8 units. There's an estimate of about $568,000. So we're getting basically 8 brand new units that will obviously be snapped up quickly by residents, but also will serve as showcases and help us kind of flex our muscles and get into the groove of rehabbing these units and knowing exactly what we can expect to get in terms of rents on a rehab unit. And we also got a reduction in purchase price. So that was really Garrett's work. Garrett is outstanding at negotiations and figuring out the financial implications of all this. And so we got the best of both worlds. We're getting 8 brand new units, and we're paying $250,000 less than we were previously. So let's talk a little bit about the business plan, because you know, you've heard me touch on a little bit about, you know, some of the units aren't in the best shape, and we think that there's some opportunities here. So we basically identified 5 areas we think that we can take this property and turn it into a star. So number 1 is to replace the management team. Now, the management team, I'm just going to say flat out, is not good. They are not good at all. When we were doing our due diligence, we knocked on and visited every single unit, all 250 units. And we got to take a look at them. Some of the units were in great shape, some of them in not so great shape. The common thing we heard was they didn't like the management. You know, they would call to complain about a water leak or something like that, and it would be 2 weeks before anyone got there. And that's because they only have a single maintenance person on the whole site. Normally, you have at least 1 per 75 units or so. So they should have at least 3 and probably 4 maintenance people. They have 1 maintenance person. And so because of that, you have a lot of unhappy tenants, a lot of churn, a lot of, you could say, bad blood between the tenants and the management. So we know Trinity has specialized in these kinds of turnarounds. So we know that working with them, that's something we can show up on day 1, right? That's the under new management sign. That's the doing tenant surveys, introducing ourselves to the tenants and letting them know that there's a new sheriff in town. Number 2 is to improve security. So I mentioned it's a gated community, but the gates aren't, it's not like you have to enter a code to get in, right? So there are gates, but they're only just sort of closed for certain hours. The thing is, there are no security cameras on this property, not a single one. For comparison, we own a property in Branson, Missouri that is literally 1/3 the size of this, 83 units, and we have 50 cameras on that property. And that makes all the difference between whether it's problem tenants or people coming and going that maybe you don't want to be coming and going. We feel like that's going to go a long way to make the current residents like the place more and then attract new residents. We're going to rehab the units, and we'll get into that in more detail in a moment. By doing these three things, that's going to upgrade the tenant base. I'm going to be honest, not every tenant there right now is our ideal tenant. We expect that those are the ones that will churn out quickly once they realize that the management is more aggressive about enforcing rules, that we have cameras everywhere. So if you're doing something that's not on the up and up, you're going to get caught and kicked out. So, you know, by doing these first three things, this is what's going to attract the better quality tenant that will want to live there because they're nice units and it's in a nice neighborhood with a nice school district. And then by doing that, that's going to raise the occupancy. Right now it's 78%, which is pretty terrible. We know in the neighborhood, 92 to 95% is more common for a well-managed asset. So we feel like there's a lot of meat on the bone with this property where simply just by doing our jobs and managing it the way we should manage it, we're going to get a lot just from that. And then of course, by doing all these other things, that will turn it from just sort of a marginal asset into a superstar. So construction plan, Rich, I'm going to ask you to unmute yourself. And, you know, Rich and I worked together to create the scope of work on this. And then Rich went up and spent quite a bit of time looking at both the current property as well as those burned units. And just tell us kind of what the plan is and maybe talk a little bit about some of the projects you've done in the past, Rich.
Yeah, absolutely. So for Putnam Green, we have a pretty robust interior and exterior renovation outside of the fire reconstruction building. And so for the exterior, we'll talk about first, we're going to do a lot of deferred maintenance on the community. And this includes, as you'll see on the screen here, repair faulty stairs. We're going to paint the entryways to the breezeways. There's some minor retaining wall repair. We're going to add some life safety in the fire extinguishers inside the breezeways as well. We're going to update and paint the front doors of the units, seal crack and restripe the entire parking lot as well. And then another safety feature that we're planning on doing is to increase the security lighting with the LED lights.
Yeah, and like I said, structurally the property is sound. It just needs some TLC to really make it shine. Talk about the interior.
Yeah, and then on the interiors, we're going to be updating the interior units quite a bit. We're going to remove and replace the current flooring with a vinyl plank flooring, new bath vanities and showers, interior lighting throughout the units. We're going to do a complete repaint of the units to some really nice color schemes. Replace smoke and CO2 detectors, brand new appliance package, resurface countertops, add a backsplash as you saw in the previous photo, and then repaint the cabinets and install the hardware. So a really nice interior renovation to the units scheduled for this property. And so the 3-year plan, go ahead, DJ.
Yeah, I was just gonna say, and we got to see, they've only rehabbed like 4 of the units there. This picture here shows you one, and you can see there's new flooring there. You can't really see too well, but they've redone the countertops and replaced the cabinet hardware and stuff. And they are nice. When you walk in, you go, oh wow, this is a nice apartment. You know, this is the kind of place I want to live in. So we know pretty much exactly what we're going to do there. It's just a matter of doing it. And this is all part of a 3-year plan. So we've got the 8 burn units. Those are just getting started right now. They're doing the trash out and about to start working on those. There's about 71 units right now that are vacant or down. So we're just going to tackle those right away, swarm those, get those up to speed. And those we think will rent very quickly and get, you know, people excited when they see what's happening on the property. And then year two and year 3, 96 units, year 2, 83 in year 3. Now those numbers are subject to modification depending on just what the leasing schedule is and what the uptake is, but this is totally doable. You know, turning this entire complex in 3 years, it's absolutely doable, and so that's what we're going to do. Construction budget. So again, we sat down with Trinity, who's done a lot of these, and just went through it line by line, worked on a scope of work, and come up with some very solid estimates. So I mentioned, you know, the initial upgrades, this 171 units. This is, you know, $342,000, and this is what we're going to swarm first, along with some of the exterior stuff, and should have that done by June-ish of next year. And then the 173 units, that's going to be the bulk of the cost, $847,000. That's year 2 and year 3. We'll have that capital in the bank. Maybe we can get to them sooner, but we broke these into 2 line items so you can kind of get a sense of what money is going to be spent where. We identified about 62 HVAC units and 53 water heaters that need to be replaced. Most of them are actually in very good shape. So that was actually a pleasant surprise to see that most of them are recent. The windows actually are very recent too. There are a few broken windows. That's the deferred maintenance we talked about. But overall, they're good windows, you know, and that's a rarity to see in a 70s era apartment complex too. So that's a nice upside. We're going to repair one of the decks. I mentioned the security cameras, lots of little plumbing fixes. We spent a lot of time doing a sewer scope and working with the contractor to come up with a very solid estimate on that. So we're confident in this number. And then I mentioned sealing and restriping the parking lot. Parking lot right now is not terrible. It's not potholes and, you know, just really bad, but it's due for some maintenance. And that's the kind of thing that, again, makes a property pop when you come in and it's all nice and freshly painted. It really will make a difference in terms of how it looks. So rent comps. The main thing you need to know is that this property is the cheapest one in the market and it's the lowest occupied. And that's because of all the deferred maintenance and because of the poor management, right? So we know, for example, the Villas at Stone Lake is at 95% occupancy and they're getting a $100 premium on some of these. So we know that if we just block and tackle and execute, that there's rent premiums there right there today. Another one I want to point out is Lakewood Estates, and I want to show you on the next slide. Lakewood Estates we actually made an offer on that. That property is literally just down the road from this one. And I'll show you a picture of it right here. And this one just went under contract for almost $54,000 a unit, whereas we're paying $44,000 a unit. So we're talking about a $10,000 difference. And so that really got us excited was when we found that out. You know, we know that a quality performing asset will attract a premium right now, today. So if we execute on our plan over 5 years, we expect that premium to go even higher. So we are definitely getting a very good price on this property. Financial projections. So the main thing I want to emphasize, and I know a lot of people say this, but it's so true, and I'll show you how it's true. We want to be very conservative with this, right? So that 78% vacancy rate, occupancy rate, the 22% vacancy, if you ask the seller, they're going to tell you it's actually 12% vacant. But we went and knocked on every single door and found that there was some ghost tenants, people who weren't paying, that kind of thing. So we just said, okay, well, we're not going to accept the seller's number. We're going to use our own number. So we boosted up to 22%. And furthermore, we know our expenses are going to go up in the first year because of property taxes and particularly insurance. So the downside of that fire is it boosted our insurance rate a bit over the first 3 years. So we know we're going to be conservative with expenses and boost the expenses. Furthermore, we're just going to assume that it's going to take us a while to turn some of these units and, you know, get some of these bad tenants out. And so we're actually projecting a minus 5% income growth in rent. So this is a super conservative projection of what we think can happen. And then, you know, really everything, it turns on how much do we turn the units and how much do we increase the occupancy, right? So this first year is a 22%, way below market, or rather way higher than the market. Same for 17%. 12%, you're starting to get into a mid-tier asset in this submarket. And then 8% the last 2 years when it stabilized. By that point, we've upgraded all the units. We've attracted better quality tenants. We've managed it a lot better so it has a better reputation and done all these things. And what we're going to get to is what the market is already doing, what some of these other properties right around us are doing. So this isn't pie in the sky. You know, let's cross our fingers and hope that we can get to this occupancy rate. This is a slow and steady growth to execute on what we already know is possible, because literally right across the street and along that street, others are doing it. So we want to be very conservative. And then the kicker is here at the end. So we're talking about NOI of about 1.3 million, or, basically doubling, more than doubling profits in 5 years, right? Well, what does that do to the purchase price? Well, we're using a sale value of 7.25% cap rate. That is a very good deal from a buyer's perspective. If someone came to me and said, I will sell you this property at a 7.25%, I would be all over it, right? So we're, again, making a very conservative assumption about how we're going to sell this property. Now, we're not going to offer it at 7.25%, right? That'd be foolish. But we're conservative all the way through, both in the profit and loss, the expense estimates, the income estimates, and then also on the sale. So a 7.25% cap rate is a very high cap rate, which inversely affects price. So the price is lower than we expect it will be. So just to give you a sense of how we've sort of baked in the conservatism through all this deal, throughout this entire deal. And this is where the numbers come from. So the investors are going to get about 3.4 million on sale. That works out to about 5.8 million total. This is where you get those returns we talked about earlier. That's a total return. After you get your principal back, it's 95. And these are the same numbers we showed you on the first slide. And as an investor, what does this look like on a year-by-year basis? This is what it looks like. So we're going to be paying that preferred return for at least 3 years, we anticipate. So if you put in $100,000, you're going to get 7,000 in year 1, 7,000 in year 2, 7,000 in year 3. And by then it should be stabilized or close to stabilized. And that's when the cash flows really start to kick in. Now you're talking about a 9.2% return, 9.5% return, and then on sale, a whopping 55%. So again, we're being very conservative in both our operating projections and in our exit price. And so that's why we're so excited about this property. And I would hope that you are too. Now, if you want to get in on this, it's really simple. You have to be accredited investors. You probably already know that. You need to invest a minimum of $75,000. The funds are due by November 15th, so that we can get the funds in and get this closed, and get to actually operating this property that we're so excited about. And all you have to do is go to this link, realbluespruce.com/portal. Adam, if you want to paste that into the chat so everyone can get it. Go in there and register, and that's where you just follow the steps. You give us your name, your email, and you fill out the form. You click invest. You tell them how much, and it'll just walk you right through it. And it's really easy as pie to invest in this. However, if you're not ready to do that, or if you ever get stuck along the way, we're here to help, right? You can ask any of us questions. These are all of our email addresses. So, Rich is our construction guy. If you want to know more about the construction plan, you call Rich. If you want to know about the asset management plan, you contact me. If you want to know more about Oklahoma City, you can contact Corey. If you want to know more about how strong the sponsorship team is, reach out to Garrett or Adam. Garrett, as I mentioned, has owned over 3,000 doors. So, you pick, I want to say pick your poison. That's probably a bad idea. Pick your dessert. What is it you want to know more about? We're all here to answer any questions. Of course, Gail is also very involved with investors, could answer any questions you have about how returns are calculated, the investment process, all of that stuff. And send us an email, give us a phone call. We look forward to having you as part of this deal, and we're happy to answer any questions you may have. And now we're going to open it up to questions.
All right, I'll read some of them off because we've gotten a half a dozen already.
Okay.
I've answered a few of them in the chat, DJ, but I think other people are probably listening and want to know the answer to the questions. So there's so many. Okay, the first one, when do distributions start? 2 people asked that.
So after the very first quarter. So that would be, realistically, the first one would be in April. So we go on the calendar quarter. So the first quarter will be January, February, March. And so April, you get your distribution. If you invested $100,000, 7% return divided by 4 works out to
1.75
1.75, 1750 you would be getting in April.
each quarter. Second question is going to be, what are the odds of a capital call? So it looks like the past investor is wondering, they're going to put in their 100K, and what are the odds that they will have to put in any other additional capital?
So with the caveat that I can't predict the future, right? It's a very low, because we're raising a lot of capital for this, for exactly that kind of scenario. So we're raising a lot of reserves. So I mentioned the construction, that's about 1.8 million. We're raising another 800,000 in reserves so that we can meet our capital commitments to investors. And also, let's take a worst case scenario. Let's say the construction plan isn't working out as planned. You know, we go in, we have 71 units and we're not getting the rent premiums that we thought. Well, we can just push the pause button. You know, as I mentioned, you know, the bulk of that, of the cost for that rehab is in years 2 and 3. I think it's about $800,000. So if after year 1, we're not getting the rent payments we thought we would, well, we can just push the pause button, hold on to that capital, and reevaluate the business plan. If necessary, even give some of that back. So I would say we're more likely to give capital back than to call capital in. We're going to have plenty of capital to work in.
Love it. And I'll answer the next 2 questions here that just came in. One of them is asking if there are any fees, and the other one is asking how our interests are aligned with the past investors. So Janice asked, are there any fees? And yes, it's the typical fees, acquisition fee. There's going to be an asset management fee, and then anything like a disposition fee that you'll see in most syndications. Those are all in there, and those are things that you want to see in there from the sponsor team, so that you know that they have every interest to make sure that they're operating the deal efficiently as they go. So yes, there are fees. And then the other question, and that was for Janice, the other question is for Arisa, who asks, how are your interests aligned with the passive investor? And there's 2 ways that our interests are aligned with the passive investor. The first way that we do that is by making sure that you have a preferred return. So before we start splitting it 80-20, which 80% is yours, 20% is ours, before we do that, we already paid you 7% preferred return. So very, very important. The second way that we have aligned our interest is that Blue Spruce is placing capital in the deal. A couple of the sponsors, a couple of the human beings are placing their private personal capital in the deal as well. I'm one of them. I will be passive. I will be on both sides. So I'll be on the general partnership, and I'm a passive investor in this deal. I just went passive in 3 other deals. And so very limited capital, but as soon as I saw this deal, one of the best deals that I've seen all year, I decided I need to be a part of this. So yes, we love this deal. We want to invest alongside with you. So Blue Spruce is putting money in, and a couple of the sponsors who you heard from today, or the other sponsors that we also have on the deal that are bringing this cross finish line, putting our own personal private capital. Some of my money's in there today, and I will make sure to invest passively. And let's see, there's more questions. DJ, there's a lot, so I'm going to give you this next one. What are the loan terms? It's a big question, especially right now in this cycle. So tell us a little bit more about the loan.
Yeah, that's a great question. I kind of glossed over it because I was so focused on this cap rate and sale. It's right here in the financial analysis. This is also in the deal package, but it's pretty straightforward. It's a 30-year amortization. The loan amount is 8.3 million, a little over 8.3 million. We're actually assuming this loan. This is what's called a CMBS loan, commercial mortgage-backed securities. And we're assuming that loan, and it's a 5-year term. It was the total term of the loan was 10 years. The seller had it for 5 years, and now we're going to take it over. 30-year amortization, good interest rate, 4.58%, and then there'll be a balloon payment at the end of year 5.
Okay, the next 2 questions I'm finding is, one person is asking what happens in a downturn, And if you want to take that, you can. If not, I can take it. The next question that we have is talking about the sponsors and the sponsors' track record. So I definitely give that to you. I know you covered that earlier, but I want to make sure that this person's questions are answered. So do you want to take the downturn and the sponsor record?
Yeah, happy to do that. So on
Okay.
the downturn, this gets back to where we're being conservative. In a sense, we're assuming the worst case scenario in the very first year of this deal, which is, much lower income, not much, but 5% lower income, high vacancy rate, high expense growth. And so, this is kind of the worst case scenario we're looking at with this. Now, you may say, well, what about 2008? What if that happens again? Well, that's an excellent question. A couple things to keep in mind about that. So, number one, multifamily, it's not immune, of course, to that kind of a shock in the market, but it's a much more resilient asset compared to single family homes. And to illustrate my point, the foreclosure rate on multifamily back then in 2008, really, we're talking about the worst situation in 70 years, was about where single family is today, which is one of the best situations in 70 years, right? So multifamily is just a very resilient asset because the very fact that you're spreading your risk across literally hundreds of tenants. So foreclosure almost never happens in multifamily. So that's one thing. Another thing is, again, let's use this 2008 scenario and look at what happened nationwide, right? So you probably heard, Las Vegas got just crushed. Some of the houses lost 60% of their value. Where I grew up near Atlanta, they were losing 40, 50% of value. What happened in Oklahoma City? They lost 6% of value. I want to say it again, 6% in the worst economic crisis in 70 years. That's what happened in Oklahoma City. That's why it's a Goldilocks market. It's not the kind of place that is prone to violent swings like that. So, if you're worried about a recession, which everyone is, we're always talking about recessions. We've been talking about the recessions coming any day now for the last 3+ years, right? Well, you have two choices. One is you can just sit it out and sit on your cash. And if you'd done that 3 years ago, you'd be kicking yourself because you sat it out. Or you can go somewhere that's a safe market with very good protection on the downside. And that's, again, what we love about Oklahoma City. Great place to live, great demographics, growing market in every way that you care about, and very resilient in the face of a downturn.
The next question was, what is the sponsor's track record?
Yeah, so my background, I'll be honest, I'm relatively new to real estate. So I've only been doing this for about 3 years. Before that, I did tech companies. So I ran a lot of different startups. And so I've got a good track record on managing companies, but in terms of real estate, I'm relatively new, which is why I partnered up with Adam, who's been doing real estate for 13 years.
Pretty
And
close, yeah.
this particular deal, we partnered up with Garrett, who's owned 3,000 doors, including 800 in Oklahoma City. And we partnered up with Gail, who owns several hundred doors. She's been doing investing for 15 years. And we partnered up with Rich, who knows how to rehab and manage these kind of projects. And we partnered up with Corey, who's done over 1,000 transactions and knows the Oklahoma City market like the back of his hand. One of the things I love about real estate is the way you can partner. It's kind of harder to do it in traditional businesses. It's a lot easier to partner in real estate just because of the way we structure our transactions. So we brought in an outstanding A team of players. And, so far we've really enjoyed working together, and I don't anticipate that changing. We're all psyched about this deal.
Awesome. And then the last question that has come in so far is, what do you love? What do you like about OKC? And I want to start just because I love Oklahoma City. In fact, so my team, DJ, and the other people that are in this team and have been together for a year looking at all the markets out there. And we took tons of different criteria to take the top 165 markets in the entire country out of thousands and thousands of cities. We took the top 165 markets, and we spent a lot of time dissecting all of these cities until we were able to come to OKC. OKC, just to give you a couple highlights, what you want to look for as passive investors, you want to look for somewhere that is growing every year. OKC has literally been growing 30 years in a row. In fact, the last 10 years in a row, there has not been one year that they didn't grow by 1%. Remember that metric, because that's a metric that you're going to want to look for as a passive investor, but it's going to be hard for you to find areas that are actually growing every year, 1% year over year, especially like OKC, my favorite market. They've been growing 1% year over year for the past 10 years in a row. And not only that, but look at projections. The next time you go and find a market, it's going to be hard to beat OKC. We couldn't do it. So this is something for you to look at. Are we going to be continuing to be able to grow for the next 5 years while we own this asset? And if you look at the CoStar report, the place to be when you look for metrics and data, if you go and look at a CoStar report, you will see that OKC will continue to grow 1% year over year at least. Some years are growing up to 1.4% year over year, and that's because of this. They're bringing in jobs. There's already job diversification. We already showed on the slides a little bit earlier that with job diversification, some people think, just mistakenly, because it's in Oklahoma, right? And there's a lot of oil in Oklahoma, so they would say, oh, this must be all dependent on oil. But if you take all of the jobs throughout the entire state of Oklahoma, and then you just look at the city of Oklahoma City, and you take the top 2 markets, which are not oil, but you take the top 2 markets, and those top 2 markets combined are 3.5 times bigger, just those 2 markets in that one city, than the entire state of Oklahoma's oil and gas jobs. It has an amazing diverse economy. And not only that, but I'll say real quick, the education is huge. People want to live where they know that their children are going to get a good education. Crime stays away from good education, and the opposite of crime happens when you have a good education. And our kids at this community are going to an 8 out of 10 school, a 9 out of 10 school, and a 10 out of 10 school. When you look at the elementary, one of the best elementaries is walking distance. When you look at the high schools, very important. One of the best schools is right there in that area, and that's why we love not just Oklahoma City, but this submarket in the northwest corridor of Oklahoma City, where everything is happening. So many different things. So if you have anything else to add on top of my OKC rant, because I do love this city, please feel free to chime in, DJ.
No, I think that covers it. I mean, I draw a comparison when people talk about oil and gas. I compare it to, let's go back a few years to the year 2003. Why 2003? Well, in 2003, Microsoft sold about $150 million worth of stock that they owned in Apple. And the reason was because Apple is a computer company and Microsoft dominates the computer market. So Apple is just a bit player, right? Well, now Apple is literally the largest company in the world. If Microsoft had held on to that stock, it would be worth $56 billion. And that is because they were looking at it from the wrong angle. People want to look at Oklahoma City and think, oh, it's oil and gas. It's not oil and gas. It's much more diverse. It's an affordable place to live. We're able to buy these properties at deep discounts compared to some of the more expensive markets. And we're just really psyched about it. So we feel like we're getting into kind of a hidden gem of a market that already has a lot going for it, but it's only going to be more good news as we go down the road.
Awesome. So the questions have slowed down, so I think we can wrap it up. What I just threw into the chat is this website, Real Blue Spruce. Crud. Is this the right link?
Oh, maybe not. Here, I'll do it.
Is there supposed to be a .com/portal?
Yes.
Okay, forgive me. So it's realbluespruce.com/portal. And that's because you want to invest in this deal. You want to invest with this team. You want to invest in this market. So just click that link, realbluespruce.com/ portal. And that's our investor portal. That's where you can register your interest. You're going to want to read the PPM. Well, that's where you find everything and anything that you need to do with this deal. And it is going to oversubscribe. That's obvious. This is a great deal. We're only raising a small amount of capital, 6.2 million. We have a lot of investors on our list. It's something that's going to oversubscribe. So what you're going to want to do is you're going to want to hop on there and register your interest immediately. And that is going to lock you in. And all funds are going to be in the bank on November 15th. So on November 15th, that's when your funds are going to be in. And then we are going to be ready to close. And I'm excited to work with you. Just go to realbluespruce.com/portal. And that's where you get all of this information. That's where you will see the PPM. And Corey is saying, sharing all signs point to even more growth in OKC. Totally true. In fact, Dave Lindahl, he wrote this book called Emerging Markets. So I think he knows a thing or two about emerging markets. Oklahoma City is one of the absolute top markets on his list. And Forbes magazine also recently claimed that this was a recession-proof market because the prices are incredible. The last time there was a crash, the most we saw in the worst crash was 6%. This is a great deal, and I'm excited to be working with you. Go to realbluespruce.com/portal, and we look forward to working with you.
All right, we're going to wrap it up. Thank you, everyone, for joining us. And I really look forward to having you involved in this deal. We are super psyched about it. Thanks, everyone. Bye-bye.